Welcome to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank that brings you market views and insights on the go.
Welcome to Standard Chartered Money Insights. My name is Marco Iachini, and I'm a cross-asset strategist from our Chief Investment Office team. On this episode of the podcast, we discuss the implications from the latest FOMC meeting and what effects those might have on financial markets and the economy. Joining me for this conversation today, I have the pleasure of welcoming Steve Brice, our Chief Investment Officer. Without further ado, let's dive into our conversation. Now, it looks like the Fed is now siding with the markets after raising its inflation and GDP forecasts for the U.S. What did we learn from the FOMC meeting, Steve, and what did the market's reaction tell you?
So in terms of the Fed, obviously they struck a much more confident tone in terms of the outlook. So I don't think their central view has changed that materially. But the range of outcomes around that central view, I think, has reduced. So then, the downside risks in particular, they seem a lot less concerned about. So they're more constructive on that outlook. They did increase the inflation forecast for this year quite materially, so to 3.4% from 2.4%. So that's really chunky, but didn't make significant changes going forward beyond that. So they did mention, Powell mentioned that there is a risk that inflation could be more sustained than expected, but they do still believe that to be temporary. And that obviously is really, really important when talking about the policy outlook. And overall, this to us makes a lot of sense. So they've brought forward their central expectation for the first rate hike from 2024 to 2023. So that's obviously got a lot of headlines in the press. To us, that's actually too far away to really worry about at this stage. But obviously it did affect some of the pricing, which we'll talk about in a second. The key thing for us is probably more, what's going to happen on the tapering side. So we've seen significant quantitative easing, obviously around $120 billion of asset purchases every month. So the expectation is that's going to be reduced at some point. And they are talking about tapering now. So we believe that's likely to start in Q1 of next year, potential with an announcement at the end of this year at the December meeting. And overall, that's pretty much in line with market expectations. So we did see, obviously, markets react to this. So equities were down, fairly minor, 0.5%. I think that got some headlines because we're not used to our markets falling these days, but 0.5% is pretty much nothing. Bond yields did go up a decent amount, around 7 basis points. The dollar bounced from key support and gold came off from key resistance. So, we did see some market reaction, but I think, we should put this in a bigger context and say, look, this is to be expected given the way that the economy is developing, and it doesn't really change the big picture in our view.
I understand. Thanks, Steve. Yeah, in fact, the market's reaction after the latest inflation data and also now with the news coming out of FOMC seemed like the market participants were in a way kind of expecting or saw something in line with regards to what we saw out of the meeting. Now, my next question, since we have had, and you mentioned tapering, we've had some episodes in the past, obviously, to refer to with regards to tapering. How do you think this time will play out, and what would be the implications for financial assets?
Well, I think that there are obviously some potential digestion challenges with this shift that we're seeing from the Fed. Obviously, a lot of people are making comparisons to 2013, the taper tantrum that we saw there, where we saw a significant risk-off environment, although quite short-lived, actually, and actually markets did rally, point to point from the taper tantrum through to actually tapering taking place. But that is a concern that we could see some volatility. I think what the Fed has done better this time is it's less of an adjustment than we saw in 2013. So we did see, quite a big change in expectations there, whereas now this has been reasonably well signaled. So I think the risk of significant downside for markets is lower this time. I think also if you say, we're thinking about taking the foot off the accelerator. So we're not taking the foot off the accelerator. We are thinking about it, and we're certainly nowhere near tapping the brakes. So when you pitch that against the big picture, in terms of improving growth story globally. I mean, yes, the US has been leading that and with the UK, but Europe is taking part in that, and we're seeing other things elsewhere as well. Fiscal policy is still supportive in the US and likely to become more so in Europe. And obviously monetary policy is, as I say, is still not hitting the brakes. So against this backdrop, our view is that equities are still preferred. Bond yields are likely to be relatively contained, so we do see slight upside bias to US Treasury yields, for instance, but we see those as being relatively contained. And we are still bullish on gold, despite the sell-off that we saw in response to the Fed. So we're still looking for around 2,000 in 12 months' time. So not a lot has changed in our asset class views post the Fed, but obviously that short-term volatility risk is still there.
Okay, and one other aspect that I know the team has written a lot about so far in the first half of the year has been obviously that within a reflationary environment, usually value equities or value style equities tend to do better, and related sectors as well. Has anything changed on this aspect within equities? Do you still prefer the more value-oriented sectors, or what else can you tell us, Steve?
So I think it's really important to go back to our original thesis as to why we liked value equities. So it's not just a pure factor of what's happening in markets or economies. We have seen a long-term downtrend, multi-year. So going back 10 years-ish, for value equities to underperform growth equities. So that trend actually is still in place on the long-term picture. That nothing's really changed necessarily on that. But what we saw in 2020 was a sharp down move or acceleration of that trend. So really when we came out with our view that we thought value would do well in 2021, it was really initially just saying we expect some sort of convergence back to that long-term downtrend, and that would lead to a very sharp outperformance of value. And that's actually what we've seen so far this year. So we have seen that starting to take place, and that can continue. So we're still not back to that sort of downtrend yet. So we're still significantly below that downtrend. So there's still scope for this. And I think if anything, the Fed statement just reinforces that could still continue. We're talking about less scarce growth. So we saw slight upward revisions to growth forecasts. That's consistent, we believe, with modestly higher bond yields. And that's an environment, as you indicated, that value can continue to do well. So from our perspective, that's still a key theme of ours. It obviously also plays in and is consistent with our preference for European equities, where there's a significant value tilt. There are other reasons to like Europe, of course, so increased progress on vaccines. Relative fiscal policy actually is likely to turn more positive to Europe in the second half of this year, or certainly the fourth quarter. And earnings revisions are very strong, strongly being upwardly revised in Europe as well. So value we still like, still see further room for this to go. And obviously, as I say, that plays into Europe overweight as well.
Thank you, Steve. Switching gears for perhaps our last question today. You mentioned earlier in the presentation the move in the dollar. Obviously, that has big implications for asset classes and obviously significant implications on other currency pairs. What can you tell us? Are there any changes here?
Yeah, so I think from a dollar perspective, obviously, there's been some speculation that this could lead to dollar forming a base, right? So I think historically, when the Fed's actually raising interest rates, it's almost a toss of the coin whether the dollar rallies or it falls. But as people start pricing in interest rates in the next sort of 12, 18 months, then that can be dollar supportive. We're still suggesting we're a little bit outside of that window. So we still believe that the dollar is likely to decline. We still need to get through really key support around just below 89 on the dollar index. So it bounced back above 90, 91 following the Fed's announcement. But ultimately, we do think that break lower is going to come to pass. So from that perspective, just to give you some levels that we like, So euro, we're looking at around 128 in 12 months, so mid next year. Sterling, we're looking around 148 against the dollar. Australian dollar around 81 cents, and the Sing dollar we're looking at around 113. So overall, we do see this dollar weakness story playing out pretty much against all currencies. The one exception to that could be the Chinese renminbi. That's really quite strong already on a trade-weighted basis. So from that perspective, maybe the Chinese renminbi will benefit less from dollar weakness.
Thank you, Steve. Thank you for joining our conversation today. That is all for this episode of Standard Chartered Money Insights. If you'd like to learn more or read our publications, please visit our website at sc.com under Latest Market Insights. As a reminder, if you enjoyed our discussion, please rate and review us wherever you get your podcast. Thank you for joining us today.
Thank you for listening to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank. For more details on the latest market insights, subscribe to Standard Chartered Money Insights.